everyone. The recent budget proposals announced on 23rd July 2024 propose a major overhaul in the capital gains tax system with an aim to bring in simplicity and uniformity in tax rates and holding periods across all asset classes. Let's take a look at the impact of these tax proposals on the investments in mutual fund schemes. Starting with equity mutual funds. An equity-oriented mutual fund scheme is one having minimum 65% exposure in listed equity shares or domestic companies. The threshold period for qualifying as long-term for an equity mutual fund continues to be 12 months. For redemptions of equity mutual funds from 23rd July 2024 onwards, the tax rate has been hiked from 15% to 20% for short-term capital gains and from 10% to 12.5% for long-term capital gains. However, the tax-exempt amount for long-term capital gains has been raised to 1,25,000 per year, which is likely to benefit retail investors. Let's now turn to non-equity mutual funds comprising of debt or money market funds, FMPs, gold or silver funds, gold or silver ETFs, overseas fund of funds, etc. The date of purchase of non-equity mutual funds is relevant to determine the taxability post these budget proposals become effective. That is, whether the investment in non-equity funds was made before 1st April 23 or after. If you invested in any non-equity mutual fund scheme on or before 31st of March 2023, then you were earlier eligible for long-term capital gains tax at 20% with indexation benefits if you held the unit for more than 3 years. The indexation benefit has now been removed. Instead, the holding period threshold has been reduced to 12 months for a listed scheme and 24 months for an unlisted scheme. And the long-term capital gains tax has been reduced to 12.5% but without any indexation benefit. The short-term capital gains would continue to be taxed at applicable slab rates. Let's take an example. Suppose an investment was made in a corporate bond fund, which is an unlisted scheme, on 20th of July 2022, and this investment was redeemed on 24th July 24 after the budget proposals have become effective. Since the holding period is now more than 24 months, this would now attract a long-term capital gains tax at 12.5%. However, if this was an FMP or a gold ETF investment, which are listed schemes, the holding period threshold would be 12 months. So now what happens to investments in non-equity mutual funds made from 1st April 23 onwards? In the Finance Act 23, investments made from 1st April 23 onwards in specified mutual funds with equity exposures of up to 35% were deemed short-term and taxable at applicable slab rates. This definition has now been revised to funds having debt exposure of more than 65% from 1st April 25 onwards. So in case you invested in any non-equity mutual fund scheme on or after 1st April 23, then in that case, for redemptions up to 31st March 25, the existing tax treatment would continue. The capital gains would be deemed short-term and taxable at applicable slab rates for all schemes. For redemptions from 1st April 25 onwards, the capital gains on pure debt schemes having debt exposure of more than 65% would continue to be deemed short-term and taxable at applicable slab rates. However, in case your investments are in gold or silver funds, gold or silver ETFs, overseas fund of funds, etc., in that case, these funds would not qualify as a specified mutual fund since the debt exposure in these schemes is less than 65%. In this case, the threshold period would now be 12 months for a listed scheme and 24 months for an unlisted scheme. And the long-term gains would be taxable at 12.5% without any indexation benefit. Let's understand this with an example. Suppose an investment was made in a gold ETF, which is a listed scheme, on 1st April 23, and this investment was redeemed on 30th of March 25. In this case, the gains would be deemed short-term and taxable at applicable slab rates. However, if this investment is redeemed on 5th April 25 instead, the gains would qualify as long-term since the holding period is more than 12 months and would be taxed at 12.5%. However, if this was a corporate bond fund where the debt exposure is more than 65%, the gains would continue to be taxable at applicable slab rates irrespective of the date of redemption. The question now comes to tax treatment of hybrid funds, such as multi-asset allocation funds, which have more than 35% equity exposure. These investments earlier qualified as long-term if held for more than 3 years and were taxed at 20% with indexation benefit. For redemptions on or after 23rd July 24, the holding period threshold would be revised to 24 months since this is an unlisted scheme, and the long-term capital gains tax rate would be 12.5%. This position would continue even for redemptions made from 1st April 25 onwards in multi-asset allocation schemes, since these schemes generally have a debt exposure of less than 65%. We hope this presentation provides useful insight in understanding the impact of the budget proposals on your investments in mutual fund schemes. Please note that these budget proposals are subject to presidential assent. Thanks for watching.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.